think we're good to go. All right, good morning and welcome to the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. Topic this morning is understanding the difference between cash flow and profit. We get this one a lot. Most clients look at the bottom of their P&L and they feel like the amount on the bottom of the P&L should be the dollar amount that is in their bank account. And in many cases, it is not. There's a reason for that. There are a lot of different things that are happening that create that difference. And those are the things that we want to talk about today. So it is important that you do understand as a business owner the difference between cash flow and profit, because it's really going to drive a lot of the decisions that you're going to make in your business as you're looking to not only grow your business, but just to maintain your business in the long run. So really cash flow, the components of cash flow is really the dollars in and the dollars going in and out of your business. And that's really affecting the liquidity. So the dollars coming in, is it all dollars coming in from your revenues? Do you need to borrow money in order to kind of get from point A to point B? So from a cash flow perspective, borrowing money, we consider that in that inflow of dollars coming out. It doesn't affect your profitability, but it affects your cash flow. Now, the same thing, expenses, dollars going out the door. Not every dollar going out the door is an actual direct dollar expense. For example, if you have purchased a vehicle or a piece of equipment, or you have a debt, when you're paying that debt back, not all of it is going to be deductible. The interest piece of it is going to be deductible to you, but there's a total cash outflow for the entire loan payment. So again, cash flow is dollars in and dollars out, regardless of whether it's revenue or actual expense that's going to affect your P&L. And that's where we start to create some of those overall differences. So cash is king in every business. You need to have enough money to pay all of your bills. You need enough money to operate your business, to potentially buy new assets if you need them, to spend money on generating new revenues. It really is the lifeblood of your business. If you don't have cash in your business, if you're profitable on paper, having no cash, it really is a detriment. And there are many businesses in history who have gone out of business because they were not cash positive. They might have been profitable on paper, but they were cash flow negative and they couldn't maintain that business. And if there's no cash to pay those upcoming bills, then again, not only will you have no profitability, but the reality is that you probably won't stay in business very long. So let's talk a little bit about kind of the different types of profit now, right? We talked a little bit about cash, right? Cash coming in, cash going out. Let's talk about profit. So we talk about gross profit a lot, especially with our construction clients, because that really is, for them, is a big driver, is a number that kind of drives the overall direction of the business. So gross profit ends up being, it's really your revenues less your expenses to actually generate those revenues, those direct expenses. So in a construction business, it's typically going to be the cost for materials, the cost for labor, right? Any of the kind of extenuating costs related to those construction projects. Maybe there are permits that you're purchasing for those projects. Some of our clients, we work with a number of roofing clients. A lot of our clients spend a bit of money on drone footage in order to kind of see all aspects of their projects. So again, those are direct costs associated with driving those revenues. And so in all business, you definitely want to have a positive gross margin, that's for sure. But in construction, it's actually really, really important. If the overall projects themselves aren't profitable, then the reality is you have no chance of being profitable in the overall business because you still have operating expenses that you really need to consider in there. So again, kind of there's that gross profit, right? So it's revenue less the cost to actually drive those revenues. And then the next thing is going to be your operating profit, right? And so that's going to be revenues less the costs to drive those revenues. So again, the cost, we're going to call them cost of goods sold. We're going to use that as kind of a general term. But it's, so gross profit is revenues less cost of goods sold. So that's your gross profit. So you get here. The next thing is you're going to have your operational profits, right? The operational expenses, the expenses that don't go away every month, right? So maybe you have rent, you're in an office and you have rent. And again, there might be utilities and whatnot that go with that. Maybe you have a couple of operational team members. More and more companies are using more softwares in their offices. So again, those are the expenses that don't go away. So then you've got your gross margin, you've got your operating expenses, and then now you're going to get to your operational profit, right? That's your next step. And then the last would be your net profit. And what we're considering in the net profit after those expenses we're considering are going to be your things like your depreciation, your income tax, if you have it, your interest expense, right? You've heard people call it, a lot of times you've heard people call it EBITDA, right? So that's really what we're looking at. So again, you want to make sure that once you get, there are 3 different layers. So you're going to have that first layer, you want to be profitable, you want to be the next one and the next one, right? Anywhere in there where you're not profitable or you hit a negative number, again, you're going to start to run into some cash flow concerns because now you're spending more money than you actually have revenues coming in to pay for those. So profitability, again, is different than cash flow because profitability could be revenue less expenses, and that's your profitability. One of the things that you want to think about when you're considering all of this is really timing. And timing is really what's a lot of the difference between the two. So depending on the type of business that you have, maybe you have the type of business where you're sending out an invoice to a client and you're waiting for that client to pay you. You've now recorded the revenue in your ledger as being, you've recorded the invoice in your ledger as being revenue to you, and now you're waiting to get paid. So there's a time between when you recorded that revenue and when you got paid. And again, we could look at your profit and loss statement right now and see that it might be profitable, but you haven't gotten the cash from that invoice yet. So again, we've got some timing issues there. You're going to have the same thing with your expenses. You're going to have timing issues there. You've gotten an invoice for materials that you've purchased. And we see this with many of our clients. They purchase materials. Most of the materials vendors are going to have some type of payment terms. Maybe it's 30 days, maybe, and in some cases, depending on who the vendor is, if you actually look at the days, it's 30 days after the close of the month. So sometimes the actual payment date could be a good 45 to 50 days away. So you've incurred the expense today for that work, but maybe you're not paying that bill until 45 days from now. So you have that cash. So again, there's timing differences between the two. So cash is all the cash coming in, cash from revenues, cash from debt, all the cash going out, the cash for expenses there, cash for things that are not going to be deductible expenses, right? Dollars that are going to go out the door versus your revenue and your expenses. So those are going to be 2 different things. They're not necessarily going to be the same. I think sometimes the terms are used kind of commingled and people get confused about that. Again, we've had that where we've had clients say to us, hey, I have this profit dollar down on the bottom. I don't have that cash. Well, you've got some timing issues. You are an owner and you're taking distributions out of the business. So you've taken cash out. Again, the cash is gone, but you're profitable on paper, right? So those are all timing things that you are going to run into in your business that are really going to affect your profitability as well as your cash flow. So there are going to be different metrics that you're going to want to look at in your business, depending on what the type of business that you have. And so you're really going to want to look at those, and you want to be able to evaluate your company's ability to generate the income, but also to pay the profits, to pay all your operational costs, and really ultimately pay back, in some cases, your owners or distribute profits to your owners. So again, you've got a couple of different things going on there all at once. So again, cash flow, we keep it simple. When we're talking here, we're talking, dollars in and dollars out. There are statements. So there's a statement of cash flow as accountants that we use, and that we look at. And so we're looking at, different things in your statement of cash flows. We're looking at your operations, your investing, and then as well as your financing. That's not the depth that we're going to get into here. In some cases, those are things that clients aren't necessarily interested in. I think the most important thing to really think about is kind of the dollars going in and the dollars going out. So again, your cash flow is how much money is coming in and out of your business. Your profit is really going to show you how much money is left over after you've paid all your expenses, right? So that's going to be a big differentiator. Your cash flow is reported on a statement of cash flow for an accounting purposes. Your profits are reported on an income statement, again, for accounting purposes, two very different things. And again, a business could be profitable on paper, but have negative cash flow, right? So you're profitable on paper, you've invoiced a bunch of different customers, but they haven't paid you yet. So again, you've seen it over time and in history. There are times where businesses that are profitable on paper just aren't cash flow positive, and they aren't able to maintain because they aren't able to keep the cash flowing in their business. There are going to be a handful of items when we're, thinking about cash flow. You're going to have your non-cash expenses. So a lot of times depreciation and amortization tend to be those expenses that you'll see on a P&L that don't necessarily directly reflect dollars in and dollars out. So again, now you're backing out certain numbers to arrive at another number. And so that's where we start to see a lot of the differences. And again, your accrual accounting versus your cash basis accounting is simply going to be those timing issues, right? You're recording the revenues that you've generated. You've done the work is done today. You give a customer an invoice, you've earned the revenue, but you're still going to wait to get paid. So those are the types of things that you want to think about and you want to look at too. Cash flow is one of those things that you want to consider and look at in your operations on a daily basis. Where is your cash coming from and going to over the next week, 4 weeks, 13 weeks, right? Because that's going to be directly affecting your operations over the, the upcoming period. Profitability really is going to be a driver kind of in your long-term sustainability, right? Can you get from point A to point B? Can you get out the next 12 months? You need to monitor the cash coming in and out over the next 13 weeks as well as the 12 months. But again, what's that path to ultimate profitability? And that's going to be more of like a longer term gain. The last is just kind of balancing the two. You want to be profitable, but you also want to have cash in the bank. So really, how can you get the dollars to come in quicker and also hold on to them longer so that you either aren't spending them on expenses or you're at least maybe pushing the expenses out at a later date? Again, it starts to become a little bit of a play on time. Where are things ebbing and flowing? Where's the cash coming in? What can I hold off on? And so on. So again, cash kind of coming in and out, but am I profitable? Is my job profitable? This is the revenue we've earned. This is what we've spent on it. We may still be waiting to get paid on that. And we may still have some invoices outstanding, to our vendors for that. But again, am I profitable? Are you profitable on that job? Are you profitable on all your jobs? And then considering the cash, like when are we going to get paid on that outstanding invoice, right? So you've got two different things going on there. So you can't rely on profit alone. You really have to have the cash coming in. You've got to be cash flow positive. Just because you're sending out $500,000 worth of invoices doesn't mean that, you might be profitable on paper, but you don't have that cash in the bank. If you're waiting 30 days, 60 days, 90 days, and sadly in construction tends to be a chronic problem is the wait, is you're waiting to get paid in many cases, especially when you get into the more, the commercial related work, where it could be, 60, 90 days before you get paid. On paper, you've earned, the job is closed, you've earned that revenue, but you haven't gotten paid on it. So you can't rely entirely on profitability. You really need to have cash, driving your cash at the same time and trying to drive it as closely as possible with your profitability, so that you can, in fact, kind of continue on and, move your business forward. Without cash, you can't keep going. So if you just have profitability, but you're not getting any cash in the door, again, you take a very big chance of not being able to sustain your business moving forward. And you want to make sure that you're not only considering the profitability in your business, right? The profit on your jobs, but again, when the cash is ebbing and flowing, so you're forecasting out your cash. You're forecasting your projects, the profitability of your projects, but you're also forecasting the cash. When are we going to get the cash in, and when do I need to send the cash back out? So there again, you're considering two very different things: the actual profitability on the job, what have we spent or what are we going to spend on this job, versus what cash has actually gone out the door or what cash has come in the door. As always, if you have any questions, please feel free to reach out. We'd love to hear from you whenever you can, send us any questions. We look forward to seeing you here every Friday. Again, I am Lisa Raish. I'm the construction CPA. We are dropping the hammer on cash flow problems so you can build things that matter. And we'll see you again here next week. Have a great day.